Happy Friday, BOSA boys and girls. So happy to have you here today. You're going to want to stick around. We got two things to show you. I got a beautiful Russell YM spread trade that we did today, netted over $1,200. But we're introducing now another indicator to give us a long-term look at how spreads are operating so you can get a good visual picture. It's called the dollar difference indicator. I'll go over it after I do the recap, so you want to stay tuned. All right, thanks again. Hang tight. Let's get right into it. BOSA traders, hey, how are you today? Hope you're doing good. Had a really good day Friday on the 11th of November, so let's go over it. This is a big couple days in the Russell and YM. Huge days. So the news came out on was it Thursday? Big rate change. So the Russell has just been going nuts compared to the YM. So this is an opportunity for us to hop on. Here is a spread of the Russell against the YM. So long Russell, short YM, and it just skyrocketed off the opening. I didn't jump on it, but it would have been a great opportunity to buy the spread. I'll do a trade-by-trade breakdown of what actually I did trade, but let's take a look at the setup here. So you're familiar with our exhaustion triangle. I'm just looking at the strong lows and the weak highs. And we do that with a very simple idea here. We draw these triangles. So this is a weak high, this is a strong low, and this is a weak high. What happened is this low was put in and the price broke through the high, so the weak high was broke. That's a strong low. That shows buying is happening here, and it is a support. It's a strong support. This is a weak resistance. So the weak high is up here, the strong support is down here, and we're looking at going higher. So that keeps on going up, up, up until we get to a point where we start breaking that strong low. We break through that strong low, now we have the old-fashioned structure reversal. That's a key part of our picture. So again, BOSA spread system, we're looking for a reversion to the mean. When in the stock indices, for example, we see the Russell 2000 take off compared to the YM, the 30 industrials. So we're looking at a correction. Either the Russell 2000 will revert back and come back down to a normal level, or the YM will catch up with an explosive stock move. And that's what we're betting on here. So that's what we're putting our position on. And we use this exhaustion triangle to give us an entry point for that. I would have been interested in selling it, or considering selling. This is the first red dot we've seen in the whole day. We've been going up, up, up. It's just stratospheric. It's way above the volatility band high, way above the equilibrium line, which is the yellow line here. And that means we're looking for that reversion again. So the exhaustion triangle is from a high to a low to a new high. And we see a break of that level right in this area. We're down below the fast moving average. Things are lining up really good. In addition to that, the spread itself historically is way, way, way down here. The spread is below the midline in this entire day. Since we're so high above it, we're looking for that pressure to return, and it does in a pretty stunning fashion. So let's go over each trade. I took 3 positions in this market, and it was later on, much later on. You'll see the first one here at about 2:30. So this is the actual shot from the actual trade time. So the spread, we have it as an even, +1, -1. So the YM is 30% more volatile than the R2Y in dollar terms. So it's not enough for us to consider going long 2 R2Ys to compensate for that. So we're just going to stick to a 1-on-1 spread here. Makes the math pretty easy. And I took a short right here. So first of all, we're looking again at the trend signal dots. So we've got a bot here because we've got 3 dots green. There's a short here because we have 3 dots of red in the fast moving average in the trend. Blue is 3 dots of green. Now, the reason why I bring that out is once we see this kind of back and forth action without much happening, we're in a consolidation phase. This is about 2 in the afternoon, Eastern Time. And we're looking for the market to break out of this consolidation. We don't expect it to stay just bumping back and forth forever. This is a pause. The market has already moved down quite a bit, as I showed in that prior screenshot. So we're going back and forth. And when we see these waffling back and forth, we're looking for a breakout. This is going to end. And based on all of our analysis so far, we're overbought. Expectation is down below the equilibrium line, which is quite a bit down. We're above the upper volatility bands. We're expecting a down move. So after 3 or 4 of our trend reversals, I start taking notice of this down move right here. And I do enter short a 1 as it retraces and touches the fast moving average line. I took a little heat. This is all the heat on this trade that I took. Even had a buy trend signal because we had 3 green dots upward. I ignored it. I think I had my stop above that level though, because I wasn't looking for too much move, but you know, you can always re-enter a trade. Well, it never did touch that stop loss. We just went down, down, down. I went short another position as we revisited the high of that move. That was a little bit early, premature. So right here when this bar struck up, going up into that supposed resistance level, I did sell another spread. I took a little bit of heat. I was already well in profit at this point. I already had my stop moved to to be a break-even plus some. And then as the market moved down to that level, I went short again based on a touch of this red line. Very simple. We're looking for a continuation. I was looking for just a couple $100 move. We were at this point we were up $670 on 3 positions, and I held for that target. And let's take a look at what we did. We kept moving south. I moved my stop loss trailing stop downward. Again, our target is down here, and lo and behold, we hit it perfectly right as the market was coming near the 4 o'clock hour, and that's what I like to get out. Thankfully, we touched that perfectly, and we touched that level just right on the money, because here it is. That's where we got touched. We hit that level and the market bounced up. I exited the position right there at the ideal price of the day and came up with $1,205 for that day. So a beautiful day. So I want to show you what I've been doing. I've got another approach here to analyzing our spreads. And let's go over this. So this is a 5-minute chart. Now, I don't trade the spreads on a 5-minute chart. I go for the 1 minute. But in this analysis, in this new indicator called dollar difference, I'm loading 500 days of 5-minute data. And I'm taking a look at the Russell, which is up here, and I'm shorting the YM. So you can see that on the right. There's a RTY, which is the red line, and the YM is the blue line. And this shows the dollar difference every 5 minutes of the notional value of these two instruments. You can see right here as the RTY took off, the notional value went up. The YM tanked Friday. So that's why we had such a huge spread move in this spread. Because when you buy in the Russell and sell in the YM, this is a huge difference. So you're gaining money in both directions. This was a really divergent move. And this indicator now, dollar difference, is going to be my new go-to indicator. Take a look at historically how these things move and how they move together or apart. So we've got that, and what this indicator also provides, it's hard to see, so I'm going to zoom in a little bit. This gray histogram is the average of the two. So over the last 500 days, so this is a lot of data. If you go long this spread, it's underwater. So the average shows that we should be below the 0 level. usually the YM is above the Russell. And that's what this histogram is showing. But that's not too relevant because these pink dots are the standard deviation around that level for each 5-minute period of the day. So the standard deviation is huge. So this average doesn't mean too much because the standard deviation is just blowing it out. The average is great, but the variance around that average is pretty significant. So what does that mean for us? So what I look at here with this indicator now is the standard deviation level. So in the standard deviation is about $800, $900. Okay, so that's from this average level here, which is about -137, up to here, which is about 853. That's about $980, right? So if we do a $900 standard deviation, when the spread moves apart more than $900, I draw a yellow line between the two. So it gives me an alert when that spread is way outside of at least one standard deviation. This is all outside of the standard deviation for those time periods. You can see right about 10:30 or 11 o'clock, the spread after the open and after news came out and markets went haywire, the spread starts moving and contracting closer to one another, and we ended up going short here. You can see the Russell spread trade. So we're wide apart here, and I was shorting the spread. So this big distance, we wanted it to reduce. If you're shorting this distance, you want it to contract. So if you shorted at, let's say this value is $2,000 difference, you want to buy it back at $1,500, right? So you sell it at $2,000, you buy it back at $1,500 or $1,000, and you profit the difference. So this huge volatility we expect to contract. We expect it to come together. So either the Russell is going to move backwards toward the YM, or the YM is going to catch up with the move, get with the program, and at the end of the day, we're going to get closer to one another. And that's what this chart is showing us, is that in a big move like this, we tend to move back toward one another, and that's what we want to trade. Let's take a look at a prior day. So not every minute is outside of the standard deviation. These last 2 days have been notable exceptions. So we were outside of the standard deviation basically up until the whole day, up until 2:50 in the afternoon, and then we didn't print. We were inside of the standard deviation on the bars here that don't have a yellow line. So we're inside. So when we go from outside of the deviation to an inside or normal move, we're contracting. And this would have been a great time to short the Russell, which is the red line, and to buy the YM, which is the blue. And this is another way for us to look at that spread chart. If we go back to the spread chart itself from BOSA, we'll see that this is probably a peak level, and now they're coming together. So this spread would be moving downwards toward the median. So this is kind of a deconstructed BOSA. The volatility is crazy here, and we're moving back. Here is a little pop. We moved outside of standard deviation. We had a big spread. You see the YM is going down here into that time. The Russell is going up still. This just popped outside, and this would have been a great sell opportunity. Again, you would sell that and you would buy that. So when the spread is too large, we end up selling it. And had we done that, that would have been a great move. Let's take a look. I want to draw a ruler for you. See what this distance here is. It's about that. So it's about $1,033 difference between those two. Let's draw another ruler, and let's see if we were to get out at 1600 hours, which is 4 o'clock, right? 1600 from here to here, you can see the huge reduction in value. So we went from 1,033 down to 679, and that's a $400 reduction. And it's, you know, they're pretty close to one another. They look pretty close, but with that expansion of volatility and the contraction, let's go up here just a little bit more to get on that level. So 700 bucks to 1,033. So you're 330 bucks difference. And that's what we're looking at. That's how we make money with BOSA. The volatility during the open, the mid part of the day, the lunch hour, contracts down into the end of the day. That is how BOSA makes money. Looking at this chart, you know what? There's another way we can do it too, isn't there? That is at the open. It's a little bit more of a risky move. Now you're not shorting this in this situation. You're buying it. The Russell just took off. See, the Russell was taking off upward here. The NASDAQ was diving down. Had you bought this spread, you want Russell to go up and you want NASDAQ to go down. This would have been a huge opportunity as well. You can see if we had bought right in this area, if we saw the Russell going up here, and let's say we got a bad fill, we went long right here. We went long when the spread was 550 bucks apart. We took a little bit of heat. Here it's about the same distance away, but look at this move. And YM tanks, and the Russell tanks a little bit, but the YM, it drops considerably. So we made this a $540 difference, right, between those two levels, the notional values. This would have been a buy right here, and we would have looked for that increasing volatility, and basically anytime in this whole day, if we sold out, we would have been golden. And that's how that would have been traded. Would have been great. There are days here that we're always within the volatility. Now this is overnight. While we're getting near overnight, there's just the standard deviation is there, but we're not outside of that. So the standard deviation is big here. Look for places where we're outside of the norm, where volatility is expanding, and where good opportunities occur. And, where you might want to stand aside. So here is a day we just had nothing going on. So this was the 3rd of November. Historical volatility is standard deviation is at these levels. This spread just stuck with one another. So the Russell and the YM were very close to one another. They moved in tandem quite well here. Let's go back. Even here overnight hours, we had some volatility on this day. Right off the bat, we had some good volatility here. Now this is the 2nd of November. And had you gone, since the YM was above the Russell, right, the blue was above the red, you go buy them and sell the Russell, and that would have been a great trade. Russell tanked, YM stayed pretty consistent, and that is the spread difference that you make a profit on. So there's a lot here going on. We're constantly making new tools. This one, dollar difference, is something that we could run on the side. We can analyze any instruments we want. You put your long instrument or the long leg here at the top chart, and the indicator lets you supply a background instrument right here. We're putting the YM. You could put anything here. We're going to do an analysis of the 6A, 6N next. But so this is a comparison of the Russell and the YM, and we can see historically there are periods that move, and that's where BOSA can make some money. Hey, thanks for joining me. Really appreciate spending the day with you, and have a great weekend, and we'll see you in the markets on Monday.